Well, the Consumer Sentiment Index for February showed a welcome lift of 1.9%. It's now up to 109.1. So if you recall, it lost some ground in January, particularly when we saw the lockdowns before Christmas. But we've regained about half the loss that we made in January. Now bear in mind the December number of 112 was a 10-year high. So at 109.1, we're getting very close back to that 10-year high. And this is really important that we have this recovery in consumer sentiment, because a big challenge for the Australian economy will come in the March quarter when the JobKeeper package is withdrawn by the government. 1.6 million people were drawing on JobKeeper in the December quarter. We think in the March quarter it's down below 1 million, but still 1 million people losing their JobKeeper support is going to be a drag on the economy. But on the other hand, we know that the household sector has accumulated a huge buffer in their savings over the course of COVID, about 200 billion, which is 15% of income. So the real question is, how will they spend that money to offset the drag on the economy from the withdrawal of JobKeeper? And of course, the key ingredient to that outlook is confidence. And with confidence near a 10-year high, we have to say this index is suggesting that the Australian economy will cope pretty well with the withdrawal of JobKeeper in March. Compared to a year ago, the index is now up by 14.2%. But it's interesting that if we look at the three age categories, the 18 to 24-year-old group, the 25 to 44-year-old group and the above 44s, the 18 to 25-year-olds are actually down by 2.3%, and the other groups are up by 20% and 15% respectively. So what's happening? Why are the young people more negative? I think there's two factors. The first one is that they haven't responded as positively to the developments around the vaccine as the older people have. Presumably the older people have more concerns about health. And secondly, when we ask them about their finances relative to a year ago, young people are down by 11%, whereas the overall groups are up by 11%. So there's factors around wages, around job prospects, and possibly also around concerns about the rise in house prices. The index also provides us with some insights into the housing market itself. And we saw a 3.2% fall in the question, is now a good time to buy a dwelling. That's now down 8.6% from the peak in that cycle. What it's saying is that we see this measure of time to buy a dwelling as being a measure of housing affordability. So while people are obviously aware of the incredible strength in the housing market at the moment, some people are starting to be concerned about the squeeze on affordability. And once again, we've seen those measures lower for the 18 to 24 age group than we do for the older people. Not surprisingly, that squeeze on affordability is consistent with a 6.5% jump in the outlook for house price expectations. That is now at a 7-year high. So you can see strong confidence about the outlook for prices, which is going to particularly support the re-entry into the market of investors, but owner-occupiers and first-home buyers getting a bit put off by the fact that affordability is starting to get squeezed. It's also interesting that that house price expectation index surged in New South Wales and Victoria relative to the other states. So those two big housing states, the ones that attract most of the investor activity, are really surging at the moment, and we can expect to see that as we go further into 2021. Another factor behind the strength of the index has been the support of the economy by the Reserve Bank. And of course, last week during the survey period, the Reserve Bank announced an increase in their commitment to buy government bonds of 100 billion. The market wasn't expecting that. And they certainly weren't expecting an announcement as early as February. But what that's doing is that it's confirming the commitment by the monetary authorities to supporting the Australian economy. They also confirmed that they won't be raising the cash rate until the inflation rate is sustainably between 2 and 3%. Now that's consistent with wages at 3.5 to 4%. And I think the authorities are thinking very much in terms of inflation, employment and welfare. And the welfare story has to be associated with stronger wages growth than we've seen. And of course, as I pointed out, the young people, we think their confidence is weaker than elsewhere, I believe partly because of weakness in their wages. So on Friday, we saw the Reserve Bank's forecasts were released. And they surprised us by only believing that wages growth will be at 2% by June 2023. And they've told us they won't be raising interest rates until wages get to 3.5 to 4%. So you could be excused for believing that the Reserve Bank doesn't expect to see that wages target of 3.5 to 4 before 2025. But markets are thinking very differently at the moment. The markets, if we look at the swap curve, the markets are saying that in 1 year's time, the 3-year swap rate will be 0.38. So if you've got a central bank buying government bonds at 0.1 and a 3-year swap rate at 0.38, that's just not going to work. So what I'm saying is that there's going to be a high degree of tension between the markets and the Reserve Bank announcements over the course of this year, as markets start to believe that the Reserve Bank will have to curtail its targeting of the 3-year bond rate at 0.1 a lot earlier than the forecast the Reserve Bank is putting out around the circumstances for the cash rate. That's going to be a very, very interesting time for markets this year. Our view is that the Reserve Bank is going to be a lot more patient than markets are currently expecting. Thank you.